Hey everyone, happy Thursday, March 27th. It's about 10:45 in the morning on the West Coast, and it's time for another market update. Well, this week, as the markets try to, digest all the new tariff news, whether they'll happen, when they'll be enacted, and things like that, and then waiting for tomorrow's ever important PC inflation data, we did get a look at appreciation. We did get some new home sales data and the last look at 2024 GDP. But the main thing I wanted to talk about this week, like I mentioned, was January appreciation. So it's still climbing. This is good for homeowners, not necessarily good for people, again, that want to see home prices drop. But according to Case Shiller, which is the gold standard for home appreciation, home prices year over year now are climbing about 4.1%. They were up about 0.6% month over month compared to December. And then, as you can see at this graph, it's kind of mirroring what the year over year NAR, the National Association of Realtor, median price is. So, as you can see, they stay pretty close in touch. So we're at about 4.1% right now. The FHFA, which throws out cash deals and jumbo deals, they have that number at about 4.8%. So sub 5%, not as fast growing as they were about this time last year, but still, going up quite a bit. And like we talked about before, a lot of that why that's happening has to do with supply and demand, just basic economics. So the demand when we get to housing is what we call household formation. So that's someone moving out of the home, someone basically creating a new household somewhere, whether it's a divorce, whether it's a kid moving out of their parents' house, and so forth. So that average over the last 5 years has been about 1.8 million a year. New households we are being formed, so new homes that we need, or new apartments, or whatever it may be. So we're about a 1.8 million average. We're about that right now. So again, that's what the demand is. The supply side of things is housing starts. So new privately owned housing starts. So this would be either, again, we're looking at apartments, townhomes, homes, single family homes, things like that. So this number, we've kind of been, oscillating this 1.3 to 1.6 range. It's at 1.5 million currently. Over the last, let's see, about 3 years or so, we've been in this range, this 1.3 to 1.6. So as you can see, that number is below our demand. So our supply is running around 1.5 right now, and our demand's about 1.8 ish. So we're about 300K, new homes needed or new units needed each year, running at a deficit. So that is all price supportive. So that's a good for home appreciation. The other kind of couple graphs I want to take a look at here real quick is the annual appreciation over the past 83 years. So this is every year if you bought a home, how much did your home go up that each year? So as you can see, besides our housing recession 2007 2011, there's only other one red spot on here. It's 1990. It's at a little minuscule drop of 1%. Things look pretty flat in that era. As you can see, these last few years, 2021, these big jumps. Last few years, we've been 6.5. Right now, again, we're running at about 4.1%, so this drop a little bit. But as you can see, it looks like for the last 83 years, for the most part, it's been very, very good each year to be a homeowner, as far as these appreciation numbers. The other way to look at this would be cumulative. So the last 10 years, if you bought a home in 2004, what would your home be worth, 10 years later? Basically a 14% gain. Again, the only red you see on here is if you bought in 2006. 2006, 10 years later, you're about 3% behind. And then again, if you still own that home, you've got that back pretty quick once we hit the pandemic. But again, just an example to go show, how much of a benefit it is financially for people to own homes, just because the amount of equity we gain and the appreciation over the years, and especially when we take into account that we're running a deficit. We're basically need more housing than we're producing. Next thing, so like I said, we got some home sales data. So we got February's new and pending home sales, and both were up from a pretty slow January. Starting with new home sales, they were up 1.8% month over month, now up year over year 5.1%, kind of filling that gap when we didn't have a lot of inventory. Median price about 415,000 across the country. Sales price was down about 3% month over month. I know that some of the builders are starting to do a little bit more credit, so that probably dropped that a little bit. Month supply is showing 500,000 homes right now for sale, but keep in mind only 119,000 of those are completed. The rest are either not started or in construction. And most people, some people are okay building a new home and sight unseen, but most people kind of want to see the finished product before they make the purchase. So again, good to see them bounce back a little bit after a rough January. And then pending home sales were up about 2% month over month, still down about 3.6% year over year. The current sales pace is about 4.26 million a year. And again, an index, this is, from NAR, their index is, if it's below 100, that means there's less than 5 to 5.5 million annualized sales. And again, we're at 4.26. So bounce back after a slow January, still down year over year. Obviously, a lot of that has to do with mortgage rates and inventory and things like that. So hopefully, as rates come down and more people list their homes, we'll see those numbers jump on the pending and existing sales side of things. Next thing, so we got this just today, I believe, the 2024 with the final reading of Q4 GDP. So basically, at the end of the year at plus 2.4% annual gain. Their previous estimate, the third look at it, was 2.3%, so a little bit higher than estimates, but slow, it's a little bit slower growth than we've had the previous year. So it sounded like, according to the report, consumer spending, so us Americans spending a lot of money out there, is kind of what propped these numbers up a little bit and made them gain a little bit compared to the previous one. So again, Americans spending a little too much money, but good to see some growth. But again, too much growth, is generally when we will see the Fed not making any changes to the rates because they think the economy is doing fine. So we want this number to come down and seem a little weaker, at least, for the Fed to consider cutting rates. Initial jobless claim. So this number was estimated at 225,000, came in at 224. I think the last 4 weeks have all been in that 221 to 224 range. So very consistent, pretty low, actually. Continuing claims still high. So it'll be interesting to see if any of these government layoffs and things like that start reflecting in unemployment claims. So where does that leave us? The average 30-year last week was at 6.71. We're about 6.8 today. So it's obviously gone up a little bit over the last week. We've really stayed in this 6.7 to 6.9 range now for about a month or so. So pretty tame week. I think a lot of it has to do with, again, these tariffs and everything going on that front. I think the markets just don't really know how it's all going to play out. So these next few months will be interesting to see what policies get put in place, how those affect the economy, and how that trickles down to mortgage rates and so forth. But again, nice to see below 7. Like to get down to 6.5 or 6. Important dates, like I mentioned, tomorrow we get the very important PCE inflation data. Again, the Fed's paying very close attention to that. Any surprises there, good or bad, could affect rates pretty quickly. BLS jobs report a week after that. That's a big one. CPI and other inflation data that April 10th. And then we'll get another, at least I know we'll get another PCE and BLS jobs report before that May 7th Fed meeting, which I believe right now is about an 85% chance they do nothing. They keep rates right where they're at, 15% chance they cut. So in order for them to cut, we're going to have to see some job weakness and some inflation data, and then probably some of the political narratives to kind of fit what they're looking at. So overall, not the worst week. If anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope everybody has a great week, and we'll talk soon. Thanks, guys.